So this week has already started pretty harsh. Monday had a lot of things. After market close, Trump said this. Under sleepy Joe Biden and the radical left Democrats, the average American household monthly utility bills went up 30%. I never want Americans to pay higher electricity bills because of data centers. Therefore, my administration is working with major American technology companies to secure their commitment to the American people, when we will have much to announce in the coming weeks. First up is Microsoft. So they're going after Microsoft first, who my team has been working with and which will make major changes beginning this week to ensure that Americans do not pick up the tab of their power consumption in the form of paying higher utility bills. So Trump is basically saying that he does not want Americans to pay high utility bills just because hyperscalers are building data centers. Now, Bloomberg believes that the data center space could quadruple in 10 years. So you understand why Trump does not want the American people to be paying for these energy consumption. In this report as well, Trump has been an AI booster promising to block cumbersome regulations and increase available energy. But late Monday, he fired a warning shot arguing technology companies must pay their own way to amid rising electricity prices. Microsoft will be the first to make major changes according to the president, which means Amazon, Google, and Meta are unlikely to be far behind. The report also says that the threat was forcible, and the US power demand in 2030 is set to be 25% higher than in 2023, largely due to data centers according to a consulting firm ICF. So in this video, I want to go over Microsoft, Meta, Amazon, and Google and take a look where they sit right now. So we start off by Microsoft. Microsoft has a 4.17 rating out of 5. When I look at the inside score, I see that everything looks very good. I look here, Microsoft has grown revenue at 15.5% over the past year, which is a strong growth. Also, it has free cash flow margin of 26.5%, which says the company is very profitable. Their gross margin is 68%. Their operating margin is 46%. Return on invested capital is 26%. So we all know Microsoft. We know how capital efficient it is. We know how they have huge margins. Analysts are saying that there is a price target of 34% from here. When you look at their revenue, they have a revenue CAGR growth of 13.3% and the free cash flow growth of 12.4% CAGR. Now their net income has a CAGR of 19.4%. As we know, Microsoft has 365, their Office segment, and this is a sticky side of the business. This hasn't been growing as much, yes, but this is a sticky side of the business where it's most likely when what someone buys, they're not going to cancel the year after. Their cloud gross margin sits at 68% and their cloud revenue is at 179 billion. They have an average price target of 628, coming from 468 right now. Their free cash flow change median is 17, which is why I'll put here 17. So in a normal case scenario, after leaving everything the same and changing the metric growth to 17%, you can get with Microsoft a return CAGR of 14.16%, which isn't really a double from here in 5 years. But if you wait just a bit and you can pick the price at 440 or 420, then you might get a double after 5 years. I know. This is the annoying part where I have to tell you to subscribe because 92% of the people who watch my videos are not subscribed. So I'll keep it short, but please, if you like this video, give it a like and subscribe so you can see more of these videos. We then move on to Microsoft. Now, Mark Zuckerberg has said this yesterday. Today, we're establishing a new top-level initiative called Meta Compute. Meta's planning to build tens of gigawatts this decade and hundreds of gigawatts or more over time. How we engineer, invest, and partner to build this infrastructure will become a strategic advantage. This effort will be led by Santosh and Daniel. So the whole reason why Meta stock has been beaten down was because capex spending in Q3. But Mark Zuckerberg has said that they want to be ready for what yet to comes if AGI comes, and at the same time, if they built out too much, they could use it to sell to customers. This was already planned way before that. So it shouldn't be a surprise to people that read the transcripts, because he was mentioning about how he could leverage this and selling it to customers. Tweeted and said Meta just made compute a first-class strategy by launching Meta Compute. Meta signaling that AI dominance is about owning power, chips, data centers, and long-term capacity, not just models. Tens of gigawatts now, hundreds and over time. This turns compute from a cost into a moat and reduces resilience on external clouds. This is Meta betting that AI demand will be massive and persistent for years. Meta is no longer just building apps, it is building the infrastructure layer for AI at global scale. Because as we know, Meta also has their own chips, Meta also has deals and powers, and they acquired power companies for energy, and now they're doing data centers. So they're building a whole infrastructure. Meta is not just an app anymore. Meta has a rating of 4.11 out of 5. Meta has grown revenue at 21%. This is insane. 21% for a $1 trillion company over the past year, which is a strong growth. Also, it has more cash than current liability, means it has enough cash to handle all its debts within next year if it wanted to. They have a gross margin of 82%, operating margin of 43%, return on invested capital of 26%. They have a revenue growth CAGR of 24%, net income growth CAGR of 25%, and free cash flow CAGR of 21%. For a $1 trillion company to be growing that much, it is amazing. What I like about Meta is that it's also founder-led, and I usually like founder-led companies because the founder cares about the company like it's its baby. Mark Zuckerberg also has high ownership in this company, which makes it as a motivation for him to do well to the company and perform well. Now for Meta, their annual operating cash flow growth over the past year was 26%. I'll put this as 20%. And I'll leave the average price operating cash flow over the past year of 14.9%. So even after leaving all this, you get a 20% CAGR return every year for the next 5 years. If you think this is too optimistic, then I will decrease this and put this as 17, and you're still getting 17% CAGR. And if you think that the price ratio is also too optimistic, which I don't think so, because this was their last 5-year average, then I can put this as 12, and you're getting 13.7%, and you're also still beating the market. But I don't think this is going to happen. I think leaving this as 20, leaving this as 14.9% and leaving this as 20 is actually what's going to happen in the long run. I think Meta is the best opportunity in the Max 7. It's by far the cheapest company. If you look at its forward PE of 21, which is cheaper than the actual market. Let's not forget, Meta has 3.5 billion users. 3.5 billion viewers, that's insane. That's almost half of the world that use it daily. Half of the world use Meta daily. This is so powerful for Meta. You don't understand the amount of things that they can do with just 3.5 billion people. Attention in this world is everything. Having 3.5 billion people that use your apps every day, this could be a massive leverage for Meta. Their advertising segment is still growing. Even the reality labs, which they said they were going to cut spending here and they were going to reduce 10% of their employees in reality labs, is still growing as well. They have an average price target of 825, which is 31% from here. Meta is honestly one of my favorite companies. It has the highest holding percentage in my portfolio. So having a Magnificent 7 with that much of a leverage and trading below the market is pretty cheap, I would say. Analysts give this a strong buy. They have a beta of 1.29. I honestly added to Meta after seeing this dip. We next move on into Amazon. Amazon has a rating of 4 out of 5. And if we look why, Amazon has grown revenue at 11.4% over the past year, which is strong growth. Also, it has seen its operating income increase by 25.7% over the past year, which suggests that its operations are becoming much more profitable. This is of course because Amazon has AWS, which really boosted the revenue and also boosted their margins. That's why Amazon now has an operating margin of 11% and gross margin of 50%. Before, they had their operating margin around 2-3%. The return on invested capital for Amazon is 16.9%. Anything that is above 10 is pretty nice to see. You see that the management is allocating their cash correctly and they're getting a return, a positive, good return on their money. Amazon has a total revenue CAGR growth of 21%, net income CAGR of 49%, free cash flow CAGR of 16.93%. Amazon has a lot of segments, but AWS has given them revenue of 121 billion. Their advertising segment is 64 billion, and I believe that the advertising segment for e-commerce in general is very powerful, because if you think about it, when companies do an ad, they want people to buy, and when people go into Amazon, they already want to buy anyways. So this means that companies, when they spend on Amazon, they see higher quality of customers and they see more buyers when listing on Amazon. The reason is because you already have the buyer's mentality. Their subscription is very sticky. 48 billion it has in revenue. And to be honest, I've been an Amazon Prime member since probably 2020 or 2021. I've never changed it, I've never canceled it, because I get so much out of my money. I get faster shipping, I get cheaper, I get zero shipping, and I also get Prime TV, which I personally enjoy more than Netflix. The forecast for them is $285, which is 16% up from here, beating the S&P 500. Now, if I do a DCF calculation for Amazon and I just leave everything like it is, they have a metric growth rate of 18%, which is their past 5-year average, and they have a price ratio of 23%, which is also their 5-year average. You get a CAGR of 21%, so you're doubling your money in 5 years. If you think this is too optimistic, then how about we decrease it a bit to 15%, and where price ratio, I'll put it at 20. Even after doing that, you're getting 15% retained CAGR, which is already beating the market. I think Amazon's probably going to have 15 plus returns minimum over the next 5 years. Now moving on to Google. In case you did not know, Apple picks Google Gemini to run AI-powered Siri coming this year. So this is actually pretty good for both Apple and Google, because both of these things are just plug and play. It will not cost Google much more, and it will not definitely cost Apple at all. This is actually pretty smart from Apple, because they don't need to spend on capex making their own Siri model or making it just as good as Gemini. But as you can imagine, this also could be bad for ChatGPT. And if this is bad for ChatGPT, then this also could be bad for Microsoft, because Microsoft has a stake in ChatGPT. So I would be interested to see how this all unfolds in the upcoming year and next year as well, and see where ChatGPT stands after all this. Google has a rating of 3.9 out of 5. Their forward PE is 29, and their PE currently now is 32. This is not their average PE at all. They usually sit at around the 20s for their PE. So Google is trading a bit more expensive right now. They have their gross margin at 59%, operating margin 32%, return on invested capital is 25%. Let's read this here. Alphabet has grown revenue at 13% over the past year, which is strong growth. Also has free cash flow margin of 19%, which says the company is very profitable. So the reason why they have a low rating compared to other Max 7, if you look, is because their valuation, their price to sales of 10.4 is above the 5-year average of 6.4. Their PE of 32 is above the 5-year average of 24. Their price to operating cash flow of 26 is above their 5-year average of 18. Their total revenue growth CAGR is 18%, net income 22%, and for their free cash flow CAGR is 13.8%. Google is growing immensely. They're winning in the ChatGPT versus Gemini war. As you can see, they've been growing their computing segment as well. Google subscription has been growing. YouTube ads has been growing and still taking market share from Netflix. And people use YouTube more than Netflix. And as you might think, YouTube does not have any competitor at all. Like, even sometimes when YouTube crashes, which rarely happens, but it did happen 2 weeks ago. I couldn't open the app from my phone, and I was thinking to myself, well, what else do I have other than YouTube? Like, you don't have any long form videos anywhere else aside from YouTube. So the average forecast is 319, which is below the current price, which means that if you buy right now, it could be overvalued. But analysts still give this as a strong buy. So this is really a tricky side here, because it depends how long are you willing to hold, and also it depends how much of a return that you want. If you want the highest return, then buying right now might not be it. If you want an average return, even maybe at like the S&P 500 or below the S&P 500, and you just want to hold Alphabet or Google in general, then sure, buying here right now could be a good idea. But nothing here I said in this video is financial advice. But let's do a DCF calculation for Google. So I'll use their net income and I'll put it at 15%, and I'll also do diluted share growth of -2% and a price ratio of 25%. And if you do this, then you're getting an 11% CAGR if you buy right now. So Google is a bit on the expensive side. I would not buy in right now. I know it's a good company, it's a quality company. Sometimes you need to pay for quality companies. For myself, this is a pretty much low return from what I like. There's other good companies like Amazon, Microsoft, Meta, where you can buy right now and get higher returns. And the reason I say this is it's because it's not sitting at where Google usually trades. I mean, Google usually has an average PE of 29 and a forward PE of 23. So right now their PE is 33 and their forward PE is 31.5. So you can see how Google's a bit expensive right now. It's not trading where they usually are. Multiple times it has hit their average, both for their PE and their forward PE. So I wouldn't be buying right now. I think waiting is better. There's always going to be an opportunity in the market. Everything happens. Every day is a new day in the market, and there's always news floating around that could drop the price. So if you want to buy Google, I would suggest waiting right now. So this is for the people that watched the video to the end. If you watched the video to the end, right, Primate, because I recently watched this movie in the theater, and I usually don't go to theaters. I actually like watching movies at home, but I did go just for this movie, and it's pretty insane. I don't want to spoil it, but think about it as Down Planet of the Apes, but the ape gets sick and then tries to kill their family. That's what happened basically in the movie, and if you watch this in the trailer, you get a better idea, because I don't want to spoil it, but I would recommend watching this movie if you're free in the weekend. Thank you so much for watching this video, and I'll see you on to the next one.